Welcome to the Deep Dive. Today, we're diving deep into an article by Chris Lehnes, a factoring specialist. And it tackles really one of the biggest questions in economics right now. When will the Federal Reserve raise interest rates again? If at all.
Yeah, it's a massive question, huge implications. Because as of mid-2025, the Fed's basically held rates at these multi-decade highs.
We're talking 5.25% to 5.53%.
Exactly. And that's after just an incredibly fast pace of increases through 2022 and 2023.
Right. They really slammed on the brakes. And now it's this holding pattern. Inflation has come down quite a bit from its peak, which is, well, good.
Definitely good. But it's still stubbornly above that 2% target the Fed aims for.
And meanwhile, the economy, it's giving off really mixed signals, isn't it? Like surprisingly resilient in some spots.
Yeah, the job market's held up pretty well in places.
But then you see hints of fragility maybe bubbling up elsewhere.
It's a genuinely complex moment for the policymakers. It really is. Are things stable enough for this pause to just keep going? Or is something, simmering under the surface?
Something that could force their hand back towards tightening things up again.
Precisely.
And that's exactly what this deep dive's about. We're going to unpack Chris Lehnes' analysis, look at the potential triggers he sees for another rate hike, and help you get a handle on the different outcomes he's talking about. Okay, let's unpack this.
So maybe start with the basics. The Fed's role. At its heart, the Fed operates under this thing called the dual mandate. Congress gave it to them.
Right. Maximum employment and price stability.
That's it. Keep the job market strong, keep inflation under control. It's a balancing act.
And the main lever they pull, their primary tool, is the federal funds rate.
Yeah, that's the target rate banks charge each other for, like borrowing money overnight.
And the FOMC, the Federal Open Market Committee, they're the ones who adjust that target rate.
Right. And when they adjust it, it ripples out. It influences borrowing costs across the whole economy. Think credit cards, mortgages, business loans, everything.
Okay, so how do they usually act in situations like this one? Does history give us any clues?
It does give us some pointers. The source, Lynn's article, it points out a pattern. After the Fed finishes a cycle of raising rates like they did, they usually enter this period of, extended pause.
Just wait and see.
Pretty much. Historically, that pause can last anywhere from, say, 6 months to maybe 18 months before they decide to change course again, whether that's hiking more or cutting rates.
That makes sense, doesn't it? Because monetary policy doesn't work instantly. There's a lag.
A significant lag. The full effects of all those hikes from the past couple of years, they're probably still filtering through the system. It can take, 12, maybe even 24 months for the full impact to really be felt.
So moving too soon could be a mistake? Could accidentally tip things over?
Exactly. A premature move could cause real problems, maybe even a recession they didn't need to have. So the Fed tends to prefer waiting, assessing those lagged effects.
The article gives some examples, right?
Yeah, some useful historical ones. Back in the 1980s, you had Paul Volcker fighting that massive inflation. The Fed paused, but then inflation kind of flared up again, and they had to resume hiking.
Okay, what about more recently, like the cycle before this last one, 2015 to 2018?
Right, that was a period of really gradual hikes, very slow. They paused in early 2019. But then remember, global trade tensions heated up.
Yeah.
And the global economy started slowing down. So that prompted them to actually cut rates later in 2019. And that was even before COVID hit.
And didn't they pause back in 2006, too?
They did. They hit 5.25% and paused. But that pause ended pretty dramatically in 2007 when the housing market started collapsing. That forced some big rate cuts.
So the big takeaway from history and what this analysis supports is that the Fed's default mode after hiking is just wait, an extended pause.
Yeah, they tend to stay put unless the economic data basically screams at them that they have to move.
Patience seems key.
They really prioritize patience in these spots.
But what could break that pattern now? What could actually force the Fed to raise rates again from these already high levels? This is where Lynn's article gets really interesting, exploring these speculative scenarios.
Right. Scenario 1 he discusses is a surprise comeback for inflation, a resurgence.
Even though it's come down.
Well, yeah. While the headline numbers are better, some parts of inflation, particularly in services like healthcare or housing costs, they've proven quite sticky.
Sticky meaning just hard to bring down.
Exactly. Not falling as fast or as easily as, say, the prices for goods did when supply chains sorted themselves out.
And wage growth is still a factor too, isn't it? If wages go up faster than productivity.
That's a big one. If businesses are paying more for labor per unit of output faster than they're getting more efficient, well, often they feel pressure to pass those costs on.
Through higher prices for us.
Precisely. So, according to the source, the trigger here, the thing that might make the Fed hike, would be if the PCE index, that's their preferred inflation gauge.
Personal consumption expenditures.
Right. If that rises back above, say, 3% and then stays elevated for several quarters, not just a blip.
Okay, so what kind of data should you be watching if you're trying to gauge this risk?
Well, obviously, the monthly CPI and PCE reports are key, but you'd want to dig into the details. Look at wage growth figures, especially in service industries. Keep an eye on commodity prices, oil, food, that sort of thing. And importantly, watch consumer inflation expectation.
Right, expectation.
Because if consumers and businesses start expecting higher inflation down the road, it can kind of become a self-fulfilling prophecy. They change their behavior based on that expectation.
Ah, I got it.
So if these indicators start ticking up and there isn't a big surge in economic growth to go with it, the analysis suggests the Fed might feel they have to hike again to protect their credibility on keeping prices stable.
Okay, and the timing lens speculates for this. And the likelihood.
The speculated timing in the article is maybe Q1 2026, and he assigns it a moderate likelihood.
Moderate, and the market reaction. If this happens.
We'd likely see short-term bond yields jump up. Equity markets would probably sell off because future company earnings look less valuable when you discount them back at higher interest rates, and the dollar would likely strengthen as global money flows towards those higher U.S. yields.
Okay, that's scenario one. What's number two?
Scenario 2 shifts the focus outwards, global economic shocks. Because, the Fed doesn't operate in a bubble. Stuff happening elsewhere can definitely impact the U.S. economy and inflation.
You mean like a sudden spike in oil prices because of some geopolitical crisis?
Exactly that kind of thing. The source uses the example of maybe a major conflict in the Middle East, disrupting oil supplies, pushing crude oil way up, say, over $120 a barrel.
Ouch!
Yeah. And even if U.S. demand isn't booming domestically, a shock like that pushes costs up everywhere and can feed right into broader inflation numbers here.
So, external inflation could force a domestic rate hike.
It could, in the Fed's view, if it's significant and persistent enough to threaten their price stability goal. The analysis puts the timing for this one around Q2 2026, maybe, with a low to moderate likelihood.
Lower chance than the inflation resurgence scenario.
Seems so, according to the source. And the market reaction, probably pretty volatile. You might see investors shifting towards assets that tend to do better when things are uncertain or inflationary.
Like what?
Maybe inflation-linked bonds or defensive stocks, think utilities, consumer staples, things people need regardless of the economy.
Okay. Scenario 3 is different again. It looks inward at the Fed itself, a hawkish turn in leadership.
Yeah, this one's about the actual people making the decisions, the composition, and the sort of prevailing attitude on the FOMC.
So if the Fed chair changes, or maybe different regional Fed presidents rotate into voting spots.
Right. If those incoming voices are more hawkish, meaning they're generally more worried about inflation getting out of control, maybe less worried about pushing unemployment up slightly to combat it, then that could shift the committee's overall bias.
And the source mentions there might already be a bit of a split between doves who might want cuts and hawks who want to stay tight.
It does mention that statements in 2025 seem to indicate a growing divide. So if that balance tips significantly towards the hawks, maybe through personnel changes, you could see stronger arguments for tightening sooner than the market expects.
What's the timing and likelihood here?
Well, the timing is really dependent on if and when personnel changes happen. The analysis speculates maybe Q3 2025 could be a window, but assigns this a low likelihood. It's less about the economic data and more about, well, politics and appointments.
And the market reaction if this did happen?
Probably sharp. Driven by surprise. You'd see interest rate futures, those market bets on where rates will be repriced dramatically almost instantly as traders scramble to adjust their forecasts.
Okay, one more scenario for a potential hike. The economy itself just takes off again. Re-acceleration.
Yeah, if things just get too hot,
Yep.
we're talking consistently strong GDP growth, maybe pushing over 3% annually for a while.
Wow. Okay.
And the unemployment rate falling really low, maybe below 3.5%, plus other signs of just really robust business investment and strong consumer spending.
But wait, if the economy's booming, isn't that good? Why would the Fed hike then, especially if inflation isn't already spiking?
It's about preventing potential problems down the road. Even without high current inflation, the Fed might worry about overheating. Too much demand chasing goods and services, even if supply is okay, can eventually breed inflation. And it can also fuel potential asset bubbles, financial stability concerns.
Like trying to take the punch bowl away before the party gets too wild.
Kind of, yeah. The analysis draws a parallel to the late 1990s. Back then, the Fed under Greenspan raised rates preemptively. Inflation wasn't actually that high, but they were worried about, excessive growth, the dot-com bubble, potential imbalances. They wanted to ensure a soft landing, maintain stability.
So preemptive medicine. What's the timing and likelihood for this growth scenario?
Lehnes speculates maybe Q4 2025 for this one, also giving it a moderate likelihood, similar to the inflation resurgence scenario.
And markets, how would they react?
Initially, maybe quite bullishly, because, hey, strong growth is usually good news for stocks. But that optimism would likely get tempered pretty quickly by caution as the prospect of higher interest rates starts to bite.
Okay, so those are the four main ways, according to this analysis, that we could see another rate hike. Inflation comeback, global shock, hawkish Fed shift, or the economy overheating.
Right. But it's crucial to remember the article also lays out some really compelling reasons why the Fed might not hike again, why they might just stick with this pause or even eventually move towards cutting rates.
These are the counterbalancing forces, the reasons to stay put.
Exactly. And first and foremost are those lag effects we talked about earlier. They're significant.
Right. The full impact of past hikes hasn't hit yet.
Correct. And hiking again before those effects are fully absorbed dramatically increases the risk of causing an unnecessary recession. And avoiding that is, half their mandate.
Balancing act again, maximize employment.
Absolutely. Second big reason, ongoing financial stability concerns. Higher rates put stress on the system.
We saw that with some banks last year.
You did. And the commercial real estate sector, particularly offices, is facing some serious headwinds. Higher borrowing costs, changing work patterns. It's tough. The Fed is likely very wary of adding more fuel to that fire, potentially triggering wider instability.
Makes sense. What else argues against hiking?
Global divergence in monetary policy. If other major central banks like the ECB in Europe or the Bank of Japan keep their rates lower than the U.S. or maybe even start cutting,
then money flows here, pushing up the dollar.
Precisely. It makes U.S. assets look more attractive, strengthening the dollar. And a stronger dollar actually acts like a form of tightening all on its own.
How so?
It makes U.S. exports more expensive for other countries to buy and makes imports cheaper for Americans. That tends to put downward pressure on domestic prices, helping cool inflation, so the Fed might hesitate to hike if it looks like it'll just make the dollar surge much higher.
Okay, interesting. Anything else?
Well, there's the political reality. The Fed is officially independent, but it doesn't operate in a complete vacuum, especially in major election years, like, say, the 2026 midterms or during a presidential term. They might be extra cautious about making big policy moves that could be seen as politically motivated, even if the decision is purely based on economics.
It really is a complex puzzle they're trying to solve. So many different pieces.
It is. And beyond just the headline inflation and jobs numbers, the source points out other things the Fed watches closely and that, market watchers follow for clues.
What kind of things?
Well, market indicators that kind of reflect the collective wisdom, or at least the collective bets of traders. Things like Fed funds, futures contracts.
Those show where traders expect the rate to be in the future.
Yeah, exactly. Also, the yield on the 2-year Treasury bond, it's super sensitive to near-term rate expectations, and something called inflation break-events.
Inflation break-events. What are those again?
Basically, you look at the yield on a regular Treasury bond versus the yield on an inflation-protected Treasury bond, a TPS of the same maturity. The difference between those yields gives you a rough idea of the average inflation rate the bond market expects over that period.
So if break-evens are rising, the market thinks inflation is heading up.
Generally, yes. Now, interestingly, the source notes that as of around June 2025, these market indicators were largely pricing in no more hikes through the rest of 2025, and maybe even pricing in the start of cuts sometime in mid-2026.
So the market, for now, seems to lean towards the pause continues scenario.
It does, based on current data. But, and this is a big but, those expectations can shift really fast if new data comes out or if the Fed signals something different.
Which brings us to Fed communication itself. That's a tool too, right?
Oh, absolutely critical. Their summary of economic projections, the SEPI, comes out quarterly. That includes the famous dot plot,
where each FOMC member anonymously puts a dot showing where they think rates should be in the future.
Exactly. It's not a promise, more like a snapshot of individual forecasts at that moment. but markets scrutinize it. And the Fed chairs press conferences after the FOMC meetings. Every word is analyzed for subtle shifts in tone or guidance.
And the views aren't always uniform inside the Fed, are they? Regional differences matter.
They do. Economic conditions aren't the same everywhere across the U.S. The presidents of the 12 regional Fed banks bring that ground-level perspective to the table in D.C., influencing the debate.
And sometimes they can influence things without even touching the rate, just by talking, forward guidance, or jawboning.
Yes. By carefully choosing their words in speeches, statements, testimony, they can shape market expectations about the future path of rates. Signaling they're ready to hike if needed can actually tighten financial conditions somewhat just by making markets more cautious and maybe pushing longer-term bond yields up a bit. It's a way to nudge things without pulling the main lever.
And one more tool in the background, the balance sheet. They're still shrinking it, right?
Sure.
Quantitative tightening, QT.
That's right. QT is ongoing. The Fed is letting assets, treasury bonds, and mortgage-backed securities it bought earlier mature without fully reinvesting the proceeds. This slowly pulls liquidity, or money, out of the financial system.
So that's another form of tightening, happening quietly.
It is, and they could potentially speed up QT if they wanted to tighten conditions further without actually hiking the main policy rate. It's seen as sort of an alternative or maybe a complementary tool.
Okay, let's try and pull this all together then. Based on Chris Lehnes' analysis, can we quickly recap those potential hike scenarios and their likelihoods again?
Sure. So the analysis lays out 4 main possibilities for a hike. First, inflation resurgence, maybe triggering a move in Q1 2026, assigned a moderate probability.
Okay. Second, a global shock, like an oil price spike, perhaps around Q2 2026, with a low to moderate likelihood.
Third, a shift to more hawkish leadership at the Fed. Timing is iffy, maybe Q3 2025 if changes happen, but considered low likelihood overall.
And fourth, the U.S. economy just clinically overheating with strong growth, potentially leading to a hike in Q4 2025, also seen as having a moderate likelihood.
But crucially, the analysis also presents the scenario of no hike happening in 2025 or 2026. And based on the current data, the historical tendency for pauses, and those counterbalancing forces, that no hike scenario is actually assigned a high likelihood compared to any single one of the hike scenarios.
Okay, so what does this all mean for you listening right now?
Well, I think this analysis really underscores that the Fed is navigating a very delicate and uncertain period, while sticking with the current pause seems like the most probable path right now, according to this source.
Based on today's conditions?
Exactly, based on today's conditions. But the story is definitely not over.
Right. Economic surprises could happen, unexpected global events, those shifts in Fed leadership dynamics we talked about, or just a genuine reacceleration of growth here at home.
Any of those things could absolutely bring the possibility of rate hikes back onto the table, maybe sooner than people think.
So the path outlined here, the most plausible one, according to Lehnes, involves the Fed basically holding steady through at least early 2026.
Yeah, that seems to be the base case. But importantly, the analysis doesn't completely rule out maybe 1 or even 2 more hikes if inflation just proves stickier than hoped, or if growth really picks up steam without immediate price pressures.
Ultimately, then, the Fed's next move really hinges on this complex, constantly shifting mix of factors, doesn't it? Inflation's path, the labor market's health and nature, global risks, financial stability worries.
And yes, operating within that political landscape, too. It all feeds in.
So what's crucial for you trying to make sense of all this?
I'd say it's really about staying informed and adaptable. Pay attention to those key indicators we discussed: inflation reports, jobs data, market signals, Fed communication. Understand that uncertainty is kind of the name of the game right now.
And be prepared mentally for these different potential outcomes. Don't assume just one path is guaranteed.
Exactly. The era of, let's call it, monetary vigilance, it's definitely not over yet.
Seems like it.
Agreed. The Fed is watching the data like a hawk. The markets are constantly trying to read the tea leaves, and staying aware of the different possibilities, like the ones laid out in analyses like this, is just essential.
Which brings us to a final thought for you to ponder. Considering all these really complex, sometimes conflicting signals, stubborn inflation here versus maybe softening demand there, global risks versus domestic strength, market hopes versus policy goals, just how incredibly challenging must it be for those policymakers on the FOMC to actually make decisions that have to balance price stability and maximum employment for an entire, huge, diverse economy like the U.S.?
It's a truly daunting task. No easy answers.
Thanks for joining us for the deep dive.